Welcome to day 2 of the Municipal Finance Conference. I'm Rich Reifel, a professor of practice here at the Olin Business School and one of the chairs of the conference. On behalf of Brookings, WashU, Brandeis, and U Chicago, I want to thank all the researchers, discussants, and moderators for their contributions to a great conference. A special thank you to the Brookings staff for their months of effort organizing the conference. There's a lot of work that goes on behind the scenes leading to the conference and indeed over these next 2 days to make sure this conference goes well, and I'm grateful for their contributions. Yesterday, we had some really provocative policy topics discussed, and today we'll dive into some more mechanical muni market topics. We'll have 4 papers, researchers presenting papers, and then a discussant will discuss the research, and we'll take questions from the audience. After the 4 papers are presented, we'll have a panel discussion on Puerto Rico. I'm pleased to see that we have a lot of new presenters this year. We also have several that have been with us since the conference was founded 11 years ago. It's exciting to see how the conference has built over the years. If you'd like to submit a question for our speakers, please use our Slido, SLI.do, or Twitter hashtags MuniFinance to submit a question. We'll be monitoring those and passing those along to the moderator, researcher, and discussants. Instructions as to how to enter a question were included in the confirming email you should have received this morning. We encourage you to submit as many questions as you'd like. We'll have time to get to several of them after each session. One of the objectives of the conference is to match researchers with practitioners to conduct joint research. So we got a lot of feedback yesterday by email that people found the research was quite interesting and wanted to know how they can engage with the researcher. So if you have a particular interest in a topic that you see presented over the 3 days of the conference, or just in general, I would encourage you to reach out to one of the conference chairs, and we can help make connections for that purpose. So today, moderating our session will be Peppy Finn, CEO of St. Louis-based woman-owned investment bank, Stern Brothers. Thank you, Peppy, for your contributions to the conference. We're looking forward to the discussions you'll be leading today, and the floor is yours.
Thank you, Rich. Good morning, everyone. The first paper that we will be discussing this morning is entitled Mutual Fund Flows and Capital Supply in Municipal Finance. The researcher and paper giver on this will be Jimmy O. The respondent and discussant will be Peter Block. Jimmy O is an associate professor of finance at Hanyang University Business School, who's currently on sabbatical leave visiting the University of Illinois, Champaign-Urbana. Prior to joining Hanyang, Mr. O completed military service as an Army officer at Korea Military Academy. His main research interests are mutual funds, institutional investors, corporate governance, and ESG. He holds a PhD in economics from the University of Cambridge. Peter Block, our discussant, is a managing director at Ramirez & Company and the firm's head credit and market strategist. Prior to his time at Ramirez, Mr. Block had a career at Morgan Stanley where he was the head of the trading desk. He was the head trading desk strategist, and prior to that had a 14-year career at Standard & Poor's. While at Standard & Poor's, Mr. Block invented debt derivative profiles, DDPs, a risk scoring system for municipal interest rate swaps, where he won the highest level corporate achievement award for innovation. So we're pleased to have both of them this morning. And Mr. O, if you would like to go ahead and begin the discussion on your paper.
Thank you, Peppy, for the very thorough introduction. This is joint work with Manuel Adelino, Sophia Jiangzhang, and Jaewon Choi. Right, without further ado, let's begin. So we are all here at the conference because we understand and appreciate the importance of municipal financing. That's the backbone of long-term infrastructure investment and day-to-day government operation of state and local governments. And the municipal bond market is a big part of that. It's a $4 trillion market. Now, one thing that sets this market apart from other markets is that investor composition is quite different. So if you look at this 2020 breakdown, households have a very large share of municipal bond holdings. Around a half of all municipal bonds are held by households. And among the institutional investors, what we notice is that compared to corporate bonds, where banks and insurance have been traditionally the bigger players, mutual funds hold a large share. And they are important because they have this open-end structure that makes them different from banks and insurance who have a more long-term stable investor base. So how capital supply, in other words, money flowing into these investors, affect municipal financing is an important question, yet it has not been addressed, which is an interesting thing because we have a ton of literature on equity and corporate bonds and how flows into mutual funds or insurance companies, etc., affect these financing. Now, another thing that sets municipal financing apart from, say, corporate financing is that it's done mainly through the bond market. Bank lending is there, certainly, but it only accounts for a small fraction of the total lending, less than 10%. So, first of all, the capital supply into mutual funds should A, matter, and B, it should affect the issuer's decisions. But the relationship might not be straightforward because of various demand-side frictions. Unlike corporate bonds, municipal bonds are subject to various political constraints. So, for example, general obligation bonds have to be often approved by the electorate in large. And in some states, you have to have not just 50% approval, but supermajority, 60, 67%, etc. And there are also all these decisions regarding new issuance and refinancing and etc. that we need to look at. So that glaring gap in the literature ought to be really addressed. Another thing that sets apart municipal markets from, say, other markets is that though it is supposed to be technically at length, arm's length lending, relationships matter a lot. Municipal bond markets and the bond markets are known for the very high degree of fragmentation along geographical and state-along borders and everything. So there, the relationship between issuer and the underwriter, as many of you already know, is likely to matter a lot. And mutual funds likely also maintain this ongoing relationships with underwriters. Not only they participate in the primary markets through these underwriters, they are also the broker-dealers that deal with the secondary market trading. So relationships are likely to matter a lot, exacerbating the impact of fund flows and potential issuance decisions of the issuers. One thing that I want to emphasize here is that this channel is likely unique to the mutual fund, municipal bond market, rather. Now, in the literature that we know regarding corporate equities and bonds, it's the price that drives these decisions. Managers see stock prices going up or corporate bond prices doing better, and then that affects their decision over whether to issue more or less. In municipal bonds, on the other hand, prices are pretty much non-existent. Yields do exist, but most of the bonds trade very sparsely, let's say no more than a few times per year. So that's what distinguishes this mechanism apart from what we see in the corporate side of the market. So what do? We examine the extent to which money flowing into mutual funds drive municipal bond issuance. Here we examine both the likelihood and the size of issuance. And what we talked about earlier regarding relationships, we explore that more deeply to the relationships between issuer and underwriter and funds matter in municipal bond financing. Second part of the paper is then dedicated to where do these money end up? In other words, does that finance new projects or does that fund refundings of existing projects? What sort of bonds are issued? General obligation, revenue bonds? Do voting requirements matter? So we look at the finer details of the municipal bond market. And here the challenge really is to find a good exogenous flows into mutual funds. So let's talk briefly into the story we want to rule out. So suppose that fund managers are receiving good inflows, not because the money's coming in, but because they're doing well, and they're just skilled managers. And suppose these skilled managers are good at identifying issuers that are likely to perform well, not default, not go into all these, moratoriums and everything. Then it's not that the money is driving the issuance, but it's just this underlying endogeneity that's causing all these problems. So we want to ensure that the money coming in is coming in for reasons unrelated to underlying fund or issue characteristics. Here, we're going to talk about a mechanical change in Morningstar's overall star rating. Now, Morningstar is a very influential firm, rate funds, and investors use this decision a lot. There's a mechanical change in which the star ratings are calculated at the 5-year mark. I'm going to talk about that detail in a minute. And despite this change in methodology being known and mechanical, investor flows appear to respond to this. So we look at that as an plausibly exogenous money flowing into investors. Another thing that we do is to compare within issuer at the same point in time. So by doing that, we purge out any demand side issues and then look at funds with better flows, or not better, more flows or less flows, and how that affects their decision to participate in the primary market. So what do we find? As expected, more money flowing into mutual funds increase the likelihood of issuers issuing new municipal bonds, both the likelihood as well as the size of issuance. Now, this is not a correlation, but there's a strong causal link, because even when we, identify a setting in which these money flowing in is unrelated to fund manager skills or performance, we still find issuance decisions matter in response to those money flowing in. And what we are finding also is that relationships appear to matter a lot. So funds participate in bond issuance largely from their relationship municipal issuers, the underwriters and the issuers with whom they share the sort of previous relationship with. And one interesting thing that we are finding is that this temporary money flowing into mutual funds is being used to finance bonds with lower transactional cost, or shall we say, administrative burden. So rather than funding new bonds, they're being used primarily to refund existing bonds, and revenue bonds are more common than general obligation bonds, the latter of which require voter approval. And we see this difference particularly prominent among states that require supermajority approval for geo bonds. Revenue bonds that, they are not reliant on taxing power, so you don't have to do that. And the more difficult the political constraints and hurdles are, we see issuers switching a lot more towards revenue bonds that are relatively free of this problem. So overall, they seem to take advantage of temporarily favorable capital supply conditions by opting for issuances with less administrative burden. So the data is pretty standard, information from Bloomberg and Mergent, merged with fund level information from CRISP and Morningstar, and our sample period is between 2000 and 2020. So let's talk about the Morningstar ratings. Okay, so it's a very influential metric used by fund investors. And what Morningstar does is to calculate risk-adjusted returns of fund performance. They do that for 3, 5, and 10-year horizons, assuming the fund is old enough to have return history over that specified horizon. And comparing that performance against their peers, they're either awarded, 5 stars, 4 stars, 3 stars, etc. Now, these star ratings are known to be highly influential. But there's a very interesting dynamic happening at the 5-year mark. Now, until 5 years, funds don't have long enough history to have a 5-year rating. So Morningstar calculates the overall rating using only the 3-year rating. But when the fund turns exactly 60 months old, suddenly it becomes a weighted average of 60% 5-year and 40% 3-year ratings. Why does this matter? Because the 5-year rating seems like new information, but ultimately the new information that comes in is really what happened between 3 years ago to 5 years ago. That has been known in the market for what? Already years and years. So it's a stale information. Yet this affects the fund's star ratings, 3 stars, 4 stars, 5 stars, happening at the 5-year mark. So we horse race those that have been upgraded at the 5-year mark against those that remain at their previous rating at the 5-year mark. Our question is, A, do fund flows respond to this mechanical change? And B, do issuers respond to that? So what we are finding is there's a strong flow response. Despite the fact that this information was out there in the open and known for years, unlikely to be related to managers' recent performance, which we show in untabulated tables, yet investor response seems to be strong. So that's unlikely to be manager skill or recent performance-driven thing. And in response, what we are finding is, following the upgrades, issuers' likelihood of issuance also increased significantly in the first 2 quarters thereafter. We confirm this in a more formal regression setting called the difference in difference setting as well, with controls and everything. So what we are seeing is there's a causal link. This is not just a correlation, but a causal link between money flowing into mutual funds affecting the likelihood of issuances of issuers that they hold. Now, in the last 3 minutes or so that I have, let's talk about relationship. So we know municipal bond market is fragmented, and it's the underwriters that will drive these decisions a lot. So we divide issuers and funds into those with previous relationship in the primary market versus those that without. And this relationship can be defined in many ways, right? Fund and issuer, or fund and underwriter, or fund underwriter issuer, all sharing same relationship. What we are finding is that the main relationship seems to be driven primarily by funds that share, and fund underwriters and issuers that share previous relationship in the primary market before. And what we are also noticing is that as you move from column 1 to column 3, the stronger the tight-knit nature of that relationship. So when funds are related to underwriter and underwriters related to issuer, that's where we find the strongest likelihood of issuances happening in response to money flowing in. And let me just skip this for the sake of time being. And in the last couple of minutes that I have, let's talk about where the money goes into. So when capital supply increases, which bonds do municipalities issue? The 2 obvious questions that come to our mind is, first of all, the decision between GO versus revenue bonds. GO bonds are backed by taxing powers and costlier to issue because of voter approval. And that's particularly difficult in states that require this supermajority approval. On the other hand, revenue bonds are easier and quicker to issue without voter approval. Another thing that we want to focus on is new fund financing versus refinance. New financings mainly for new projects, refinancings bond replace existing bonds, so they're generally easier to issue with lower transaction costs. What we are finding is that it's really the ones that are easier to issue where this relationship between capital supply and issuance is primarily driven. So it's the revenue bond rather than GO bond, refunding rather than new filing, where all this relationship seems to be coming from. And one last thing, this particularly seems to be driven strongly among supermajority states, the states that require strong hurdle for voter approval. That's where the issuers are opting towards revenue bonds and shunning the general obligation issuance following capital supply. So to conclude, what we find is a strong causal effect of fund flows and bond issuance using a quasi-natural experiment based on Morningstar rating introduction. And what we find in terms of our empirical results is that A, relationships matter a lot, and B, issuers seem to take advantage of this temporarily favorable money in financing bonds that are easier to issue, relatively speaking, in terms of institutional and political constraint. So I stop there, and I very much look forward to Peter's discussion. Thank you.
Great, Jimmy. Thank you very much. And now we'll have the opportunity to hear Peter's discussion.
Good morning, good afternoon. It's a pleasure to be here. Jimmy, that was an excellent presentation. You brought up a lot of excellent points, many of which I don't think many practitioners in the industry have thought about, and they're very revealing, and I think they require some further investigation. I'll try to do my best here to go over some of the salient points that you made. I have some slides, and then we'll have a Q&A and look forward to our discussion. So if we could turn to the first slide, please. So the paper focuses on mutual fund flows, but I'm also arguing that mutual fund flows are but one of the 3 or 4 major sources of capital for the municipal market. Mutual fund flows are in fact measurable, and they are a good barometer of investor sentiment and demand, and most people do follow the ebbs and flows of mutual funds as a litmus test for retail investor demand. The other major capital providers include individuals that buy individual bonds and reinvestment of maturing principal and coupon payments by all holders. In aggregate, we can simply call this market cash flow. I show at the top of the page a few years of historical asset class returns between municipals, tax-exempt municipals, taxable municipals, S&P 500, other fixed income asset classes, including treasuries and the global ag. The other metric that people in the municipal market often look at is the relationship between AAA municipal rates and treasury ratios. The 10-year Muni treasury ratio I graphed since 2008, the financial crisis, and you can see that there was a big spike in the ratio during the Fed's taper tantrum in 2013. But those are 2 key metrics that investors look at quite frequently because they're always chasing returns, relative returns and value. In a moment, on slide 3, we'll talk about some other metrics for relative value. But it's difficult to say in every instance whether or not market cash flow is actually a symptom or a cause of market weakness or strength. Usually it's a bit of both, depending upon the macro market environment and specific technical factors within the municipal market. One of the technical factors that we look at in the municipal market is reinvestment, particularly as a percentage of gross supply. We call that net supply. We can see that in this chart at the bottom of the page that there's a definite seasonality to reinvestment dollars in the municipal market, whereas at the beginning of the year that new issuance and reinvestment are generally in line with each other, while the summer months of June, July, August are typically the highest reinvestment periods, where there's a huge demand for issuance of municipals, and that usually leads to strength. We're actually seeing that now in the municipal market, wherein towards the end of June and July, the municipal market has outperformed treasuries because of the reinvestment dollars coming in and the lack of issuance that has occurred due to the spike in MMD and treasuries. So turning to the next slide. I graphed mutual fund flows since 2008, and you can see that there's definitely periods of drawdowns, and it seems to happen every so often with macro events affecting the rates and equity markets generally. Occasionally, there are Muni specific events, such as we saw towards the end of 2010, 2011, the whole Meredith Whitney scare that created massive amounts of mutual fund outflows. And then, of course, you can see, the very latest that has occurred in this year with mutual fund outflows as a result of the spike in interest rates and high inflation. Previous to that, you can see the onset of the pandemic, we had record outflows as everybody was running for the exits at once. But when dealing specifically with mutual fund flows from the underwriter side, we tend to notice the effects on issuance decisions and the relative cost of capital more when there are the acute and massive outflows that I just talked about. During these extreme periods of volatility, issuers tend to delay or downsize issuance rather than cancel them altogether. This is because many issuers in the governmental sectors in particular will issue bonds regardless of capital flows, mainly due to their programmed capital needs. In more normalized environments, the typical ebbs and flows in the market, we find that fund flows are on balance, less important to issuers' decisions as to whether or not to issue compared to just the general market stability and the certainty of execution in the market. Turning to the next slide, this is just a graph of relative value in our market as of about 2 weeks ago when I prepared these slides. You can see in the upper left-hand corner, relative value of muni to treasury ratios is really only fair right now. We're not super cheap relative to treasuries, but on a spread basis for the different sectors and the ratings within the different sectors, you can see that generally speaking, we're pretty cheap. High yield has maintained a degree of richness. And I think that's just due to the fact that there's not a whole lot of high yield bonds that trade relative to high grades in our market. Turning to the next slide, here's a graph of monthly issuance that we can see the seasonality here from 2019 through year to date. We do see that there are strong relationships between the underwriter and investors that results in best execution for the issuers. But I wouldn't say that, like I said earlier, I wouldn't say that any issuer's decision to issue bonds or how many bonds to issue is directly affected by any one or more fund inflows. I do see Jimmy's point with respect to how when there's a mechanical change in the Morningstar rating, that there are more flows into the fund, and then that fund invests more in an issuer's bonds. I personally think that has more to do with the fact that those funds may already own those issuers' bonds, and it's an easier credit decision to make to buy more of those issuers' bonds. But if anything, if a new issue is well oversubscribed, it could lead to, particularly on the refunding side, bond issues being upsized. But as we can see from the above chart, issuance is just like reinvestment, and that is very seasonal, and it generally follows a pattern from month to month. I mean, there are exceptions, of course, depending upon market stability and the market, volatility, what have you. But I do have to say, yes, the point is well taken, Jimmy, that the underwriter fund issuer relationships in the business do matter and can heavily influence the quality of execution of an issuer's transaction. The relationship between the underwriter and the funds, the investors, is also significantly impacted by a couple other factors that I don't think you brought up, which is the amount of secondary market business that the investor account does with that underwriter. That's just trading, crossing bonds, buying bonds out of the underwriter's inventory, and then that underwriter providing liquidity for that investor when that investor wants to get out of a position. There's also the historical amount of allocations of bonds when the lead underwriter has allocated bonds to that investor when that underwriter is the lead left or senior manager on previous transactions. So that heavily influences whether or not a fund is going to do business with that underwriter, because they know that, over time, they're going to get better allocations on their new issue. There's also a big component in our market called new designations. We have this unique system that's not really present in the taxable market called net designated. And net designated means that it's up to the investors to decide who gets credit for certain issues. Depending upon the syndicate rules, that can matter dramatically to co-managers and co-senior managers of negotiated underwriting business. And so the relationship between the underwriter and the investor makes all the difference on who gets what allocations, essentially, who gets paid more, who gets paid less on new issue. There's a lot of discussion around that, and I'm not going to get into that whole ball of wax, but that is a major topic in the underwriting industry as it pertains to compensation. In terms of the investor's fund relationship with the issuer, I would say that this is a relatively less important topic, except with the largest and most frequent issuers, which tend to have relationships with the investors themselves. I mean, you'll often have, quarterly conference calls, particularly in the hospital, higher ed sector, sometimes the airport sector, big transit agencies, states, what have you, where there are relationships between investors and issuers. But I think for the most part, just given the tens of thousands of issuers in our market, the relationship between the investors and the issuers is generally non-existent, except, again, for the largest, most sophisticated issuers. The other point I want to make is that the point that the paper makes regarding funds experiencing inflows and being a participant on an issuer's bonds, being more likely to buy the bonds the bonds offered. I would say that this is true, but not always. Simply because an investor already holds an issuer's bonds does not necessarily mean that just because they receive fund inflows that the investor will necessarily invest in those bonds. The decision to invest in new bonds has multiple variables, including the current market, competing issues on the date of issue, whether or not that investor is full on the name. Many investors have single name limits on who they on the credits that they can buy, and also the investor's current view of the issuer's credit quality and the yield at which that issuer's current bonds are issued. Also, of course, impacting is just the general level of municipals relative to treasuries. In some cases, particularly in the short end of the curve, it's more efficient to buy treasuries, depending upon the market versus any issuer's bonds in particular. And then turning to the very last slide, we do a forecast every year, as does all major investment banks in our industry. We're generally year over year in the middle of the pack. This year we were calling for between 450 and 470 billion of issuance. We're significantly behind that right now, and obviously because of the backup in rates, both in treasuries and municipals, and it has slowed issuance dramatically, particularly on the taxable side. Which for the last couple of years, because of the low absolute level of rates we saw, taxables becoming what seemed to be a permanent feature of our market at about 25%, but that obviously has slowed down dramatically. I'm in the process of revising this forecast down. But when we talk about issuance in aggregate from year to year, the new money component is a big variable, obviously, but one of the larger components is just the universe of current refundable bonds and advanced refundable bonds. And our guess, it's really no more than a guess, as to the percentage of current refundable or advanced refundings that will occur in the market. And that really has to do with the relative value of municipals versus treasuries, the absolute level of rates, and also a lot has to do with investor or issuer psychology, rather. The best example right now is that taxable still makes sense for advanced refundings, but it's very difficult for many issuers to wrap their heads around the fact that rates have gone up in most cases 100+ basis points. And that's one of the reasons that taxable issuance is down so dramatically versus last year. So with that, those are my final comments, my prepared comments, and I'm happy to continue the discussion wherever it may lead.
All right.
So Pepe, there's one question on from Slido for Jimmy. Is there any sense whether funds with existing underwriter relationships are buying the bonds and holding them for their fund, or are they then flipping them into the secondary market? And then I think we have time for Jimmy to respond to all those comments that Peter made.
Thank you very much. So, excuse me. So regarding your question, so currently what we are measuring is the primary market participation and primary market issuance. So yes, these funds are, sorry again, buying those relationship issuers bonds in the primary market and holding them. We don't have a good way of seeing whether they then dump this onto the secondary market or not, but if there's a granular level of data, then I think that's something that is definitely worth investigating. Thank you. Right, and regarding Peter's excellent discussion, this is exactly what we wanted from the conference. You know, you're getting the perspective from those that are in the market. It's great. And I also believe, I think we had a call before with Pepe and Peter, and it doesn't seem like this is going to be a, first order thing, that issuers are just suddenly going to find new investment because funds are suddenly getting money. They will have their projects planned and they will have their needs. But what we are finding is that it's these at the sort of margin, when those conditions are temporarily favorable, either through refundings or maybe by just taking back something that they have shelved from a few quarters ago or something, and then quickly doing that. It's plausible, and our empirical results are very much pointing towards to this, that they are increasing some of those refunding or older projects coming back type of issuances, and also happening at a larger size. And I do take Peter's point regarding a lot, some of these might have to do with funds having better knowledge and better credits regarding this particular issue. And that's one thing that distinguishes bond market from equity market, that mutual funds generally have informational advantages in certain issuers compared to others, maybe through mandates or whatever. And that's also going to be accentuating this relationship a lot. Your point regarding the secondary market relationship between broker and mutual funds is well taken. We'll look into that. Also regarding historical allocations as well. And all these, the net designated regarding the syndicates and investors pretty much deciding who gets credit. I don't think we have a good data on that front yet, but subject to data availability, I think that's a very promising avenue that we can investigate further as well. But all in all, I thoroughly appreciate all of your comments, and that's a lot of food for thought. Thank you.
My pleasure.
Great. Gentlemen, thank you both very much for your research, your time, your discussion. It was very informative. So thank you both. And we will move into the next session.
Thank you. Pleasure being here.
Thank you very much.
The next session this morning will cover the cross-section of municipal bond returns, which is a paper presented by Sam Wang, who is a vice president at Dimensional Research. The discussant on that paper will be Steve Winterstein. Mr. Wang is a vice president at Dimensional Research. He leads a team focusing on fixed income research, including strategy design and customization, empirical study on bond investing, trading analysis, as well as providing education on systematic strategies. He earned a PhD in mathematics from Purdue, specializing in probability theory and quantitative finance. Steve Winterstein is the head of capital markets at Alpha Ledger, a developing Muni blockchain agency, where he leads the origination of municipal personal debt on the firm's blockchain system. Prior to joining Alpha Ledger, he served as the head of municipal fixed income at Market Access. And before joining Market Access, he was the head of municipal strategy and research at Wilmington Trust Advisors. He has served on the board of a number of industry boards, including the Municipal Bond Club of New York, the MSRB's Retail Investment Advisory Group, the Technical Advisory Committee of Municipal Bonds of America. So we look forward to an interesting discussion with them. And Sam, if you would like to go ahead and start with the discussion on your paper.
Thank you, Pepe. It's a pleasure to be here, and many thanks to the Brookings Institution for making this happen, and thanks all the staff to helping with us on this topic. So let me share my slides. So today I'm going to present the latest paper on the systematic municipal bond strategy, the cross-section of municipal bond returns. We have a couple of items we want to cover, but I have 15 minutes to cover the highlights of the paper. So to start, I will introduce the framework to study the expected return of the municipal bonds, and then we'll move on to the key drivers, 3 key drivers of the higher expected returns for municipal bonds. And in the end, I will cover a framework to design a well-diversified low turnover strategy that incorporates all these research into practice. In order to study the cross-section of municipal bond returns, we need to find a way to calculate or estimate the expected return of a bond. For a general bond, the returns can be decomposed into 3 components. First, the yield. Second, the term. And the third is the future change of yield. For example, if you think you buy a 5-year bond, hold it for 1 year, and then sell it as a 4-year bond, the first component will be the yield you get when you hold this bond for 1 year. And the second component is when you buy the bond at a cheaper price or higher yield and sell it at a higher price with a lower yield, assuming the yield curve is upward sloping. And the last term, the third term, the future change in yield, that is random, which is not observable today. Based on many academic research and our internal research, we found that expected return from the third component is usually 0. On average, it's very hard to predict the third component. And today's best predictor of future yield curve is actually the current yield curve. So with that, we are thinking why we shouldn't incorporate this same framework into municipal bond expected return calculation. However, there are some unique features of municipal bond that requires us additional thinking. First thing, municipal bond is highly segmented and it's less liquid. Over 1 million bonds available on the market on a given day, and not all of them are traded. The second thing is the transaction cost is pretty high for municipal bonds comparing to treasuries or corporate bonds, about 20 basis points to 70 basis points for a round trip, give or take. And the last but not least part are related to capital gain taxes. Many municipal bond investors are tax sensitive, while the coupons of municipal bonds are tax-free, but the capital gain from buying and selling municipal bonds are not. So that's why we need to take this long-term investing behavior into consideration when we model the expected return of a municipal bond. In all, we propose a framework that uses yield to estimate expected return for municipal bonds, and we have data to support that. Let me continue the discussion related to the cross-sectional of municipal bond expect returns. So we have a cross-sectional data of the municipal bonds, which covers all the in the index constituent of the Bloomberg Barclays Municipal Bond Index. We have the monthly data between October 2006 and December 2021, and we run regression, a cross-sectional regression based on these data. So we found there is a reliable and positive relation between the current year and the yield and the future returns. As it's shown here, the coefficients is the coefficient of the main regression is above 1 and the t-stats is above 2. In addition to that, we also test the robustness of the regression condition on the liquidity of these bonds. Here, we group the bonds into two groups. The first group has bonds that are more liquid, and the second group has bonds are less liquid. And we have the similar result, coefficients above 0, and the t-stats are pretty high. So in conclusion, what we have here is we found a strong predictive power about the current yield on future bond returns. And we certainly want to use that in our strategy design and ongoing research. What we found next is there are 3 main sources of higher expect return. The first is related to the issuing state of these bonds. In essence, state with higher state income tax, and when they exempt the income tax from investing in state munis, these bonds are pretty much in favor by the local residents. We call this a tax clientele effects. For example, in state of California, local residents have a higher demand for Californian bonds. That drives the price high and the yields low. So alternatively, for other states that have weak or no clientele effects, as we listed here, these states include states with no personal income tax, like Texas, and in other states like states that generally tax both in-state and out-of-state municipal bonds. And the last subgroup is states like Utah and Washington, D.C. They don't tax municipal bonds in general. So these states with potentially weak or no clientele effects generally have a higher yield comparing to states with stronger tax clientele effects. And what does it show in the data? So what we do here is we form 2 portfolios based on these 2 groups, weak clientele effect states and other states, and we studied the yield difference between these 2 portfolios. If on top, we have the yield evolution over time in our sample, and on the bottom, we have the yield difference between these two group of states. And we found that almost every month, the yield spread or yield difference between these 2 groups are positive. That confirms the theoretical idea that there should be a premium between these 2 groups of states because of the different tax treatment or the clientele effects. The second premium or the sources of higher expect return we can find in our data is related to the term spreads and the term premiums. What we found here is the intermediate term bond or intermediate duration bond outperforms short duration bonds in general, but there is a strong predictive power of current term spread versus on the future term premiums. Here we show the bar charts of the average term premiums conditioned on the beginning month's term spreads. For example, on average, the term premium is 19 basis points every month, but in months when the term spread is wider, for example, above 50 basis points, we can see the term spread for the next month increases to 23 basis points. And in months when the term spread is above 100 basis points, on average, the term premium increases to 28 basis points. So there's indeed a reliable and a positive relation between the current term spread and the future term premiums. And we also showed this relation in our paper using regression, time series regression. One more thing I want to add in this slide is the relation, the positive and reliable relation is robust across different credit qualities. If we group the bonds into AAA or AA rated bonds, or alternatively single A or BBB rated bonds, the pattern is more or less similar. The third sources of higher expected return relates to the credit spreads and the credit premium. We actually got very similar result in this slides comparing to the previous slide. We found on average, the credit premium is positive, but in months when the credit spread is wider, the average next month's term premium is bigger. So you can see the increasing pattern for all the bonds, for shorter duration bonds, and for intermediate duration bonds. All these results can be found in the paper, and we also run a time series regression and got similar positive and reliable relation. With that, now I'd like to introduce you a framework to design a systematic municipal bond strategy that incorporates all these research into the portfolio design. So what we are trying to do is systematically underweighting certain segment of the municipal bonds so that we can target higher expected return while being subject to different constraints. The highlight of the strategy is we want to have a variable approach when we deciding the overweighting in between different states, different credit quality, or different duration buckets. For example, when the credit spread is wider, we will overweight lower tier bonds like single A, BBB bonds. When the spread is narrow, we might not want to do that. So this is all captured in this constraint or setup in the portfolio design. The last but not the least, I want to mention we also take the rebalancing and the turnover constraints into consideration in the portfolio design because the transaction cost in municipal bond is pretty high. So in practice, we have to incorporate that. But in the simulation, we will have a maximum turnover constraint and do the rebalancing annually. How does the result look like? Here we listed the 3 strategies with including the municipal bond market between 1 year and a 15-year maturity, a custom static credit quality strategy, and simulated systematic strategy. We can find on average the systematic strategy outperformed the market by about 48 basis points. Of course, that comes with a trade-off. The standard deviation of volatility is higher comparing to the market. And in some of the risk measures, you do see them, the underperformance in certain periods, and the max drawdown is bigger when comparing to the market. In terms of the characteristics, we can see the yield is higher for our systematic strategy. That means we are actually targeting the higher expected return if we use the yield as a proxy of expected return. And the duration is comparable, but we also overweight the lower tier bonds comparing to the market. Some might say the outperformance might coming solely from the overweighting the lower credit quality bonds. That's why we included a second strategy here, which applies a static credit quality weight. The weight of each month between the different credit quality is exactly the same as the average credit quality weighting in the systematic strategy. We can see the systematic strategy also outperformed the static credit quality strategy by about 30 basis points. So there is value add when we apply this variable approach in terms of overweighting, underweighting across different states, duration, and the credit quality. Let me summarize very quickly here about the key points we want to the key takeaways of the paper. So we found that there is a reliable relation between current price or current yield versus future return. And the sources of higher expected returns can be found in the issuing state due to the tax clientele effects, and also within the duration premium, or the term premium and the credit premium. And we can design a systematic strategy that targets higher expected return and subject to different risk preference based on the client request. And with that, the strategy outperforms the market, and certainly it adds a lot of value for a long-term investor. That's what we have for this paper. And thank you for listening to us. And I'll get back to you, Pepe and Steve.
Great, thank you, Sam. And now we'll turn it over to Steve for his comments and discussion.
Thank you, Pepe. And I apologize. I'm going to work from my notes because I want to stay on target and get through this in a short period of time. First, Sam, I really enjoyed working with you on reviewing the paper. I thought it was a good job. The way that I kind of summarize it is I visualize portfolio construction methods as a 4-quadrant grid. On the y-axis, we have total return and buy and hold strategy. And then on the x-axis, we have portfolio construction, systematic, and then traditional. I don't want to call it unsystematic, but maybe a manual process or idiosyncratic process. And I think Sam really, in the end, developed a methodology for the Southwest quadrant, that is buy and hold largely, because he restricts his turnover in his sub-indices to 0.01%, and it's systematic in its nature. And that means, in my way of thinking, it's repeatable, it's scalable, it's transparent, and it's explainable. As a foundation, he postulates, and I'll just restate this very quickly, state income taxes, term premium, and credit premium are the drivers behind expected returns. And I will say, after having had 30 years of experience, trial and error, it's very intuitive to me that this works. And I think Sam takes an historically and traditionally very loose and idiosyncratic approach and suggests a framework with a structure and rigor that is an elegant solution that is, again, repeatable and scalable. The goal, I suppose, is to replicate portfolio construction such that portfolios can be executed efficiently and quickly, and with low friction, transaction costs, if you will, have similar risk return profiles across a mandate, low total return dispersion for any given strategy or mandate. And I think he could probably articulate that those potential list of objectives in the paper, either at the beginning or in the conclusion of the paper. So the analysis, returns tend to converge on the yield to worst if held to maturity, and I think that's an underlying thread in the paper. And to increase that yield, you have to focus on low tax states, term spreads and credit spreads. Again, it's intuitive in a low turnover portfolio. Here are the things that I would consider, Sam, and make a few recommendations. First of all, I think using the same index, I'd recommend using the same index for the measurement of returns and constituents and your term structure. So I think in the portfolio, you reference the S&P Intermediate Non-AMT Index, which is a very robust index, but then you measure your periodic returns against the Bloomberg Barclays Municipal Bond Index. I just think it's cleaner to be consistent and use the same rules, if you will, on structuring the index with the index that you're measuring returns on. You use option-adjusted duration as an approach, and you and I have discussed this, Sam, so I'm not. This isn't coming out of left field. You use option-adjusted duration as a proximate measure of price sensitivity, but you use yield to worst for term structure and term premium. And of course, as we know, the market is ripe with optionality. So with a portfolio in the range of 1 to 20 years, in terms of the bounds of maturity, 96% of the portfolio in your study had a duration of less than 10 years. I recommend using OAS. An OAS model, which you presumably have for your spread duration or for your spread analysis. And I think you could be a little clearer by specifying your risk-free curve and the implied volatility that you're using. I think using a unit spread per unit of per unit OA duration or OA spread per unit of duration is a great way to define your term premium. Also, we've had this discussion, Sam. Sectors matter. For example, typically a AA hospital will have a materially different yield than, say, a AA state GO with the same rating. S&P has 22 sectors and subsectors in their indices. I think your results would be more robust if you included sectors as a factor that you're loading on or in your analysis. Liquidity. You only look at how recently bonds trade as a measure of liquidity, and I think that's oversimplified. High quality, highly liquid bonds may not have traded over the past year or so, and they don't fall into the bucket of highly liquid bonds. So you bifurcate the market only considering how recently a bond traded. MSRB did a white paper several years back demonstrating the so-called, and I'm not quoting the paper at all, but this is my words, kind of the half-life of new issues that come to market and how they trade very frequently over the first month or so. By the second month, they start to, as we call it, go away into portfolios, buy and hold portfolios, and just disappear. And from that point forward, they transact by appointment only, to use a euphemism. Several years back, BlackRock, Richie Prager, Dan Viner, and Steve Leckley developed a model for liquidity that includes market depth, price resilience, average daily volume, bid-ask spreads, and immediacy. That is, how quickly can I sell a bond without affecting its price? Translating that in the muni market, I think, is difficult. It's not without its complications, but I think it could be achieved if you were interested in developing this into a more robust process. It could be achieved through clustering or using neural networks to evaluate those securities. The study that you did took place from 2006 through 2021. On the tails of that period, we saw episodes of extreme volatility. So we saw and we saw a couple of episodes intermittently, and I think Peter mentioned these in his last talk. But essentially, we had the credit crisis on one end, we had the pandemic on the other end, and we had two notable episodes in the middle: the Meredith Whitney 2010 default announcement, and then, of course, the taper tantrum in 2013. Otherwise, the market has been relatively benign and in a steadily declining rate environment. And I wonder how the results would have differed if we were in a steeper yield curve versus a flatter yield curve environment, number one. And as I mentioned, periods of volatility matter. So with spread compression, as rates decline, bonds with higher credit premium would naturally tend to outperform. And I suspect spread widening has had more of an effect on total return over the past year or so as volatility has spiked. So with a look back, and I'll wrap up by saying, with a look back over the say since June 21, I'd be very interested in seeing how your model worked in predicting returns over the subsequent year. That is, looking from today back 1 year, when the S&P Intermediate AMT Free Index that you use as your term structure has a 1 year and year-to-date return of negative 5.5% roughly and 5.4% respectively. Finally, I guess what I would say is, and this is my experience and how I think this could be more relevant if you wanted to make it so. Investors with low turnover, buy and hold strategies, they operate on the premise that they hold the bonds to maturity. And I understand that you're readjusting the portfolio, but you have a very finite, very small threshold for turnover. And investors think of it as they rarely sell, and then their return approximately is the rolling average yield over their time horizons. The problem is that I've never seen an investor in my 30 years experience, whether it's retail or institutional, whether an institutional corporate client is classifying held to maturity or not available for sale, FASB 115, they've actually had to liquidate the portfolio at some point, whether for tax reasons, whether because of market volatility or because of a liquidity event or because of a mere change of strategy. That said, and so I think I think we need to think in terms of total return. So you elegantly and concisely describe a method of portfolio construction, and you limit the scope of your paper as such. I would be interested in seeing a factor-based performance attribution model based on the same index, where you load on effects of the curve, that is to say the yield, the parallel shift, slope, and twist, convexity in the roll, and then non-curve effects or spread duration, loading on state, sector, couponing, and the rest of it, de minimis, and so on and so forth. And using that model as a feedback loop for portfolio construction, I think may be more useful in a volatile market where asset managers are competing on total return in the context of allocating a risk budget. And with that, I'll stop.
Thank you, Steve. Sam, do you have response or comments to Steve's
Yeah, thanks, Steve.
suggestions, if you will?
All these are very helpful comments and suggestions, as we had discussed before. These points are very helpful, and many are from practical problems. So we particularly some of the discussion related to OAD, related to the callability, they are very helpful and broaden our views and thoughts on this topic. One thing I can comment on is related to the attribution. So we do have of attribution framework to study the decomposition of the returns, realized return, based on the proposed measures or factors we have put together in the paper. So I would say in this particular falling interest rate environment, a lot of the contribution are coming from the falling yields. So that's basically I'm confirming what you had observed. So that's what is true. And also regarding to the strategy performance in the first half of this year, we will see an underperformance because of the design, but over the long run, it is still outperforming, but we will see it as a risk measure embedded in this strategy, because after all, you are targeting higher expected return, and that comes with a trade-off. So, but for long-term investor, I believe the framework and the system can help them achieve their goals. So that's it. Thanks, Pepe. Thanks, Steve.
Thank you, Sam. David, were there any questions that you saw from the audience?
There's one question here. Where did you get your monthly pricing data from?
So we used Bloomberg Barclays Municipal Bond Index. We have the constituent level data for this index. And one of the reasons we didn't use S&P data, because the S&P data we have has a shorter history. So that's why we switched to the Bloomberg data. And the results are more or less similar, but the periods will be shorter. Yeah.
Okay, that's all I got. So maybe we should, Pepe, we have a break scheduled. We could come back. I'm just checking my schedule here at 12:15. Is that okay with you? Is that right?
No, actually, we're coming back at 12:30, but before we do that, I'll just ask Steve if he's got any additional comments.
No, I think look, Sam put together a very cogent and helpful process, and I think knowing that structure is very helpful for a portfolio manager who has done it on the fly in the past, and he takes this heuristics and puts it in a very practical, repeatable, transparent, and scalable process. And for that, I think it was a fantastic paper.
Good afternoon and welcome back. Our next paper covers local government debt valuation. The presenter on this paper is Oliver Giesecke. Oliver is a PhD candidate at Columbia University and a visiting scholar at the Hoover Institute at Stanford University. His recent research focuses on state and local government's finances. Previously, he has worked on the transmission of monetary policy on the cross-section of firms and the textual analysis of reports of the Federal Reserve System. Before joining Columbia University, he was a senior research specialist with the Jules Rabinowitz Center for Public Policy and Finance at Princeton University. The discussant for this paper will be Richard Cicero. Mr. Cicero is the president of Merit Research Services, an investors tools company, a municipal bond data and research company, which was started in 1985. Merit's municipal bond credit data and analytical package covers over 10,000 municipal bond borrowers. He is a member and a co-founder of the national board chair of the National Federation of Municipal Analysts. Over the years, he has been a frequent speaker on municipal bond issues and often cited in national news sources and trade publications. So with that, we will turn it over to Oliver and let him begin with the discussion of the paper.
Thank you, Pepe, for such a nice introduction. So I also want to thank the organizers for putting this paper onto the program, and I'm very happy to present today. The title of the talk will be Local Government Debt Valuation, and this is joint work with Haris Martin and Marcelo Sena. Local governments are an important entity in the United States. They account for about 1.6 trillion or 8% of GDP of public expenditures and about 10% of non-farm payroll. Despite its economic importance, we actually know very little about the financial position of those local governments. In 2020, COVID-19 has sort of brought to the fore the immediate financial fragility of some of those local governments. Back then, the federal government stepped in and provided substantial fiscal relief in form of those 4 stimuli package to local governments, which amounted to a total of about $415 billion US. So in this paper, we want to ask one question: what is the financial situation of local governments? And we're taking 2 approaches to answer this question. First, we use the financial disclosures from the ACFRs, or the Annual Comprehensive Financial Reports, for the book values. The disadvantage here is that book values are an accounting measure and they are predominantly backward-looking. In our second approach, we try to estimate the market values of local governments' equity. And here the advantage is that they are forward-looking and thus may provide a stronger signal about the financial situation of local governments. Let me just briefly summarize the 2 main findings of the paper before I jump into the main session of the paper. First, we document.
Albert, I'm going to interrupt you for 1 second and just ask you, can you make the slides larger? Is there a way to
larger? I think actually they're
may not be
taking already the full
looks pretty
screen.
good on my screen, Pepe.
Oh, all right. Okay, then that's my bad. It's not how it's showing up on mine. Sorry to interrupt.
Okay, so with that, let me briefly highlight the 2 main points of the paper. First, we document the financial health of local governments, and we find that in 2018, about 15% of cities in a nationwide sample operate with a negative net position. The negative net position is akin to a book equity position in the corporate context. If we were to use a negative unrestricted, if we were to use the unrestricted net position, which is another measure, it would be even 61%, and so an even larger share. We find that these obligations are predominantly related to legacy commitments, that is, pension and other post-employment benefits. In the second part, we then examine the market valuation and find that there's a strong positive correlation between the book and the market valuation of equity. And we find that these market values also suggest that a substantial fraction operate with a negative market value of equity. So in terms of the literature, obviously, we are contributing to a large literature and local finances. In the interest of time, let me skip that. And we are also building on a very mature literature on dynamic asset pricing, which allows us ultimately to price some of the non-traded claims in order to get the market values for those. With that, let me now get into the financial conditions. Before I do that, let me just briefly introduce the main data sources. Some of them are quite novel, at least to the academic literature. We are building on the annual comprehensive financial report, which we received from Moody's Investor Service for a nationwide sample. In addition, we manually collect those for which we have entities in the census certainty sample, but are not in that data set. Second, we are building on the annual survey of state and local government finances, which gives us a long time series for expenditure and receipts claims, which we use for the pricing. We also get information on municipal bonds from the Municipal Bond Database and MSRB-EMER. In addition, we link the debt securities to its issuers by building on disclosures which are required by the Security and Exchange Commission. So with that, let me briefly introduce our sample. We have these nationwide sample of local governments and further restrict it to those entities for which we have information in 2007 and 2018 available. So in any temporal comparison, we do not have to worry about composition effects. Our final sample contains 1,803 local governments, which cover a total population of about 107 million in 2010. Obviously, because of the data, because of the nature of the data set, these data sample is tilted towards bond issuers, and we were initially worried that these may tilt it towards larger municipalities. While that might be true, the median population is only 21,000, which we consider as fairly modest. With that, let me briefly introduce the two main financial indicators. So first, we're using the unrestricted net position as a share of operating revenues. Second, we're using the total liabilities as a share of market values of taxable properties. While none of those, no measure can perfectly describe the full complexity of municipal finances, we do think that these two measures have some merit. With that, let me now come to my first histogram and the first descriptive result. On the x-axis, you have the unrestricted net position as a share of operating revenues. On the y-axis, you have the corresponding density. We find that the distribution in 2007 is actually fairly symmetrical and centered slightly above zero. If we now overlay the distribution in 2018, we find a marked leftward shift of the distribution. Further, we realize that the left tail becomes fairly thick. Very concretely, the median of this distribution decreases from about 28% to minus 19%, and the fifth percentile, so the left tail, decreases from minus 25% to about 191%. To make that a little bit more concrete, let's take a look at some of the examples that are sitting in the left tail of the distribution. We have Chicago, Illinois, which received a lot of financial press about their financial situation. We have Hamden, Connecticut, and Dallas, Texas. Let me give you one additional piece of evidence where we relate the unrestricted net position over operating revenues to a yield spread. So in this specific case, we use the Gilchrist-Zuckerczak spread, which is essentially a duration match spread. We find that indeed municipalities or local governments that operate with a more negative unrestricted net position on average pay higher yield spreads. I do want to point out that if we now compare municipalities with a positive unrestricted net position with a very negative unrestricted net position, despite this tremendous dispersion, the yield spread is actually fairly modest. This is like 0.3%. So that's a point that I will come back to later. So this was basically the descriptives on the book position. Now, obviously, book positions have a lot of shortcomings. One of them is, for instance, that capital assets are counted at cost minus depreciation, and so this is really sort of a backward-looking measure. Instead, we now want to look at the market valuation, which captures the economic value going forward. So it's a forward-looking measure. So for that, we start with a simple balance sheet identity. So simply that equity equals assets minus liabilities. We then decompose the assets in the present value of revenues plus cash. For the liabilities, we have the present value of expenditures plus the present value of pension obligation plus the present value of OPEB plus the present value of debt. These results in equation 1, which is the market value of equity. I want to briefly go through some of the individual components and where we get them from. So cash is, simply a liquid mean, and so we take that from the balance sheet. For the present value of OPEB, the present value of debt, and the present value of pension obligation, we are building on some of the landmark papers in the literature and follow that valuation. What is a little bit more difficult is to get the present value of revenues and the present value of expenditures. So for those two components, we really have to do some work. And let me briefly describe how we do these. So for that, we are building on a dynamic asset pricing model. And before I go into a little bit more detail, let me just briefly convey the main concept. So essentially, we are postulating a stochastic discount factor, and a stochastic discount factor prices all assets in the economy. Then we're using some of the assets for which you observe actually the prices in order to estimate the stochastic discount factor, and then use the stochastic discount factor to price the revenues and expenditure for which no prices are observable. So using this methodology, we can price the revenues and expenditures consistent with those asset prices that are observable in the economy. Very concretely, we are postulating BER process for the state variables. We also postulate exponential affine stochastic discount factor following the literature, and then use observable asset prices to obtain the parameter values. To just give you a sense about how well we are doing in terms of the fit, here I'm showing you the results for nominal yields on government bonds for 1 year, 2 years, 10 years, 20 years, and 30 years. And I think overall we do fairly well. We do these also for inflation protected securities as well as the equity market as a whole. Importantly, what I want to point out, we are doing pretty well to price a representative benchmark yield in the municipal bond market. So all of the valuations of revenues and expenditures will be consistent with the pricing that is observed in the money market too. So in the interest of time, let me just briefly skip these 2 slides and maybe just summarize some of the important components in this chart here. So this is the price dividend ratio on revenue. So please don't be thrown off by the term price dividend ratio. It is essentially the present value that you get if you receive $1 additional in revenues today. And there is, interestingly, there's a large dispersion of these price dividend ratio across different local governments. And that comes from the fact that local governments are differentially exposed to the risk in the economy. So one of the big drivers that we found is, for instance, the share of revenues that you receive from property taxes. It seems that municipalities that have a large share of property taxes seem to be a bit more resilient to the business cycle, and thus they would have higher present values for each dollar in revenues. Okay, so once we have these price dividend ratios for revenues and expenditure, we are now able to use our previous formula in order to compute the market value of equity. And so here in my last slide, I want to briefly contrast the market value with the book values that we receive directly from the balance sheet. Here in the left panel, you see the market value of equity on the y-axis and the book value, that is the net position, on the x-axis. And indeed, we find a fairly strong positive relationship between these two values. It turns out, and maybe that is not a surprise, that the relationship is even tighter if we correlate the market value of equity with the unrestricted net position. And as you see here in the right panel. So let me just briefly summarize. We have essentially, we find in both instances, we find a fairly strong positive correlation. Obviously, we also find that some of the variation of market values, there's a little bit more dispersion, which comes from the idiosyncratic characteristic of those local governments. But overall, it seems like the market values support the message that we receive from the book values. And even here in these charts, we find that a substantial share of local governments operate with a negative market value position. So just briefly, let me conclude. So we found that we saw an overall deterioration of financial conditions. We found that some municipalities operate with a negative book equity position, which may raise some concern. We computed then the market valuation and found that those market values broadly support what we found from the book valuations. Lastly, I want to raise like one point that I alluded to earlier. We found like relatively little dispersion in the credit spread, despite like large differences in the financial position of local governments. And so this seems to suggest that there might be some implicit insurance by the federal and the state governments. And in fact, this is something that we want to explore in more detail in future iterations of this paper. I stop here.
Great, thank you, Oliver. Richard, your comments?
All right, can you hear me there? Yes, there we go. Now, may I ask, will I be posting my own slides or will that be done for me here?
You will be the master of ceremonies on your own slides.
Right, I've got to go. I hope I can do that technically right. First of all, let me just say, I'm grateful to get the opportunity to do this. I welcome the Municipal Finance Center's annual meeting as an opportunity for us to get the best wisdom we can from the academic community. And every year it seems to impress me. The paper here that we just heard Oliver talk about here has been one of those that has impressed me on a very important issue. When I was originally asked to discuss it, I was attracted to saying yes to this one right away, because it deals not only with the important issue is do prices match up with fundamentals, but it also focused on two of the metrics that I've been trying to get more and more people to use for a long time. We introduced them in our database when they came out, when GASB 34 provided the elements to allow them to come out. We'll talk about those elements, but the reaction in the market and getting them to be primary metrics has been slow. One a little faster. So we're going to talk about that. I think that's good. These are the four things. Let me put up my slides here. We'll see if we can keep this rolling and keep mine within a 10-minute period. That's a challenge, but I'm going to try to do that. So let me see if I can do this right. We'll bring up slides if I'm lucky. Can you see this? I've got to do the share the screen. That's right. All right, we'll snooze that and we'll look for those slides. Here we go. And put them on the slide view. All right. Is that possible, see?
Yep.
Thank you. Thanks very much. Technical assistance always helps me, so thank you. All right, in this first one, I'm just going to go over the points, the themes that I'm going to talk about. Oliver's talked about so much, and some of it I need a course in a Babel course in statistical training in order to keep up with Oliver's thoughts there. But it's more important about what his findings are from my perspective in the context of which he's making them and his team's making them. So the 5 areas that I want to talk about, first of all, is the large segments of municipalities which operate with negative net position. He calls that equity. Municipal people don't usually use the equity term very often in our lingo. It's a corporate term, and I understand where it's coming from. But the net position is a similar thing for net worth in our industry. But we have that problem based on the new elements we have since GASB 34. Number 2, the financial condition of municipalities is in decline. I picked that up in the study, and there was some reason that was made to say that, but let's talk about that. Then this is all recognized by the market in form of higher spreads, and then accounting book versus market valuations are highly correlated. And then finally, this is an important one, and one of the attractions I have is that the negative equity position, also net position, which is I'm going to try to call more often in this talk, reflects the presence of equity insurance, and that's by state and local governments. Those are important areas. They come up in our market in different language, but they are there, and let's talk about it. The first slide I have here is what I'm also trying to do, Oliver, and to others on the call here. I like what I see so much that I want to also validate it in any way that I can. And since our database does cover to over 10,000 municipal credits in 1,600 cities in 2020, the 2021s are still coming in. I'm focusing here on the fiscal year 2020 net unrestricted position. It used to be called net unrestricted assets before GASB changed the words, and comparing it to expenses and revenues. And the reason why I wanted to do both is because the study itself uses a different denominator. It uses operating revenues, which is not off the accrual-based GASB 34 of statement, NE-wide statement. I believe it's Moody's, and I believe they're using operating funds based on fund accounting, which is not accrual. But if you look at it here, and we're using expenses rather than revenues, it really shows that it doesn't make any difference whether you do that or not. So I'm going to stick with the idea of expenses in my comments. But what you're showing, and I went a little beyond, Oliver, what you did here, the bar charts in the middle are the cities. And you can see that negative unrestricted position is very strong for cities, negative 30%. And you find the same thing for states is negative 19, and for counties, not as much, 10. And this is unrestricted. And I think that Oliver covered it, but it's really important to look at the unrestricted rather than the net position. I know the state of Illinois auditor likes to use the net position. He should be using the unrestricted position. The reason why, because it's a better number if you're trying to get a better look at also the shorter term liquidity issue, because you're taking the infrastructure assets out of the picture by using unrestricted, because most of us believe they're not easy to sell. They're being sold today from time to time, but that's not the point of a city, is to sell its assets. In some cases, they can't sell it anyway. But in here, we surely validate that we have a negative position when uses bottom line ratio, which I think is very much underestimated, understated in our market. Most analysts still, or many analysts still use, and the rating agencies were slow to adopt this. They were using fund accounting and fund balance to revenues, fund balance to expenses. And by doing so, what they're missing that this has is the rich information about liabilities in total. And that is the pension and OPEB, as well as debt that's not covered by infrastructure. So with that, that gives you an idea. However, I want to say again, validation here. In the study that Oliver did in this group, they said 61% had a negative unrestricted net position. We have 65 in our study, which may be a little bit bigger, every one of them. There's no census data in here, but it's a number that's very close, and I would call it immaterial. We would agree. Now, the net position, which is also referenced in their study, if you were to look at it from the standpoint of all your assets and putting them in, would you still be positive? Actually, you're surprised that not everybody is. Most are. 80% in our study, 82% of the cities would have a positive number on net position if you added their infrastructure assets back in. Interestingly enough, some do not. And it's usually your more distressed cases. So, and what can that be due to? It's not just pensions and OPEB. Sometimes it's also due to the fact that they've mismatched their debt to capital, its estimated useful life. So they may have debt outstanding that's not being excluded, not only because of operating needs, but more so because of that mismatch in debt service. And the next slide is the financial condition of municipalities is declining. Here, we went back into 2008, and we see clearly that it has declined when you look at this number. And I did use counties and states too, but the city is the most important one since that's what our study today is about. And it is showing that it's definitely a big negative since 2014. Now, that said, you know, I wish, Oliver, I'd mentioned this specifically in our meeting we had earlier, but I think the study should have had in it that it should at least recognize the fact that GASB changed the rules twice since they adopted this methodology, and it made a huge difference on the numbers. You used 2007 and 2018. In this one here, by looking back here, you can see when they put the full brunt, they had a large portion of it in beforehand, but when they put the full weight of their pension liability into the equation in 2015, there's a very sharp drop. It also drops again in 2018 when the full weight of OPEB came in. Now you see, and this is not on the study, but it's interesting, and maybe we can come back if others are interested in it. States actually have gone up some in recently, and that's due to prior, we're talking about some changes, improvements in not only funding for the pensions. That's a small part of the potato, but they actually improved their overall bottom line significantly at the state level just prior to the COVID, and it wasn't hurt when COVID came in. In fact, you can see in here it accelerated with the thrust of all those new funding that came in from the federal government, which actually reinforces the point that Oliver makes and others in the study make here, that there's a considerable amount of federal transfers that can come into our industry. And now the third slide here is that this study says most of the decline is associated with legacy assets or obligations. I want to watch my time here. So if I start going too fast, my words, I'll lose all of you. So if you don't mind, I'll slow it down and try to finish up. These few slides here are my most important. Legacy obligations certainly are the big picture. Again, it can be some cases they don't match up debt service. That adds to it. But you can see when you look at this particular slide here that the weaker credits, the triple Bs, and even cities over 500,000 actually have the most serious, I think, negative picture on this chart. Now, the blue line is all cities, which is even a small potato city. Not to diminish it, I love those cities, but they don't have the weight of our problems that we're talking about here. And when you look at this, a lot of them are suburbs. The reason why it doesn't move sharply upward to show that decline is because of the fact that full values tied to a tremendous boom in real estate that we have had actually helped. When you're comparing this particular liability weight against the full market value, you actually provided a benefit so that this was not an overburden on the particular communities. Now, the 2021 numbers are still coming in, but you can see where they are with this amount of the results that are in so far. Okay, the next slide here. Now, this is probably one of the most interesting ones because this is what we do. This is what we're dealing with. We're dealing with the market and things that are traditional as what may be impacting spreads. I think that the paper we just talked about here has some very impressive data on spread relationships and linking them to the fundamentals. I hope this will add a little interesting insight as well. But what you see here is that the blue line is the local geo AAA yield index. And you can see it's still in historically low territory. It jumps up a little bit there in 2018 before coming down during the COVID period of time. But we're still at historical levels that are low since World War II. And when you look at the spread relationship, you have two bumps upward, pretty significant in 2014, and that's in, Puerto Rico's in that picture in that period of time. Detroit soon after. There was a number of bankruptcies by our standards, relatively speaking, and defaults that were impacting concerns about GOs. Prior to that period, it really reinforces this whole idea was there's this implied backing by somebody, and we can talk about that it usually didn't affect concerns or spreads in the GOs as much for a long time. But when we got shocked by Puerto Rico and Detroit and San Bernardino and Jefferson County, Alabama, and to go on a few others in California and places close at that period of time, you could see it bumped up to spreads. Not huge, but they are there and they're very noticeable. And then they bumped up again for COVID.
Excuse me, we are closing in on time, so
Well,
I want
you know what?
let you
The
get
most
to the.
important part, and I'm going to be able, because a lot of them could be covered very easily by what Oliver's already said. So let me just say, you can see this idea that spreads widen is inconsistent sometimes in the way we play it out. May I just say, because I think you'll find this interesting, is that just taking, I did look a lot at individual situations last week in the market, New York City, Corpus Christi, and Houston. And I found that using a 4% coupon, price to yield or price to the call in 2029, similar duration, all AA somewhere in the AA scale. New York City has a negative 200% unrestricted net assets ratio, Houston 239, and Corpus Christi positive 2.8. What you found is New York City had 177 basis point spread, which would go along with what the study that you heard about said, that there is some widening versus other credits. And Houston, which has a bigger unrestricted net position, actually has a narrower spread of 146, and Corpus Christi, which has a positive, is still 132, which isn't much different than Houston. So you can see that we have other issues that are going on. Sometimes it's supply demand, it's double tax exemption, although the cases I gave you are not reinforcing that, but I can tell you that it exists. The rating recalibration that was based upon default rate actually causes a problem to this whole idea of spreads, state protection, security provisions, all the same. This one here, correlating market with book, I'm going to just skip this because I think Oliver covered this so well. I would like to talk about it if it's of interest to others. And then finally, the last slide here, this whole idea of that our prices reflect the implication that insurance by state and local governments is a reason to keep the prices low, even when they have, and they do have, there are cases, I said, that they do have cases in which their spread is not showing up, which is my problem. I think the market should do that more than it does. And it has to do with this historical view that somebody's going to bail you out. And Barney Frank even said that in the early part of the hearings when they needed liquidity in the muni market, and they were asking Congress's help. Barney Frank, being the House Ways and Means, said, don't all munis get bailed out? So you can see that thought process was even in Congress. This concept doesn't hold true for all municipals, or we wouldn't have talked about the default and the bankruptcies we have. But this built-in legal, political, and economic system for municipals does provide some supportive system. If you overlook those factors, then you're underestimating munis. But on the other hand, the last thing I wanted to say, and the very last thing, Pepe, I want to say, is that if we all bought into the idea, or let's say if we all price bonds only as if we're all going to get bailed out, it is extremely risky proposition. I don't think, Oliver, that you're saying that. However, I think that is in the backdrop of a lot of investors in muni markets from time to time, and that it really shouldn't be there. The leverage trends we're seeing right now are unprecedented and hazardous, and if they're dismissed, we're going to run ourselves into some trouble. So I know I went a little long there. I apologize to you, beg for your forgiveness here from me, and I hope we can have some time here for Q&A.
Unfortunately, we're pretty much tapped out. I'm going to ask Oliver if he's got any concluding comments.
Yeah, so maybe I just want to briefly respond to one of Richard's point. It was point 2 about the secular decline. We have a very similar picture like you did actually also in the paper, and we come essentially to the same conclusion that there were like sort of 2 big discontinuities, that is like from 2014 to 2015 and 17 to 18 because of the additional disclosure requirements. While we think that is certainly obviously affecting our measure, we would also like to bring it to your attention that, you know, at this point, the municipal bond market was not aware about those latent liabilities before that. And so when these rating disclosures, when these financial disclosures came into effect, the market was somewhat surprised and then basically started to adjust. So yes, can we say that in principle it declined? No, maybe not, but maybe there was sort of a latent component to it that ultimately led to the decline if you were to just focus on 2 points in time.
Fair point.
Terrific, gentlemen. Thank you very much for your time and your comments. We appreciate that, and we will move on to the final paper for this segment, which is taxable advance refundings, a critical examination. The paper presenter for this topic is Andy Calatay. He is an expert on the quantitative analysis of municipal bonds, including risk management, tax management, and debt management. He founded Andrew Calatay Associates in 1990 and sold it to Intercontinental Exchange in 2021. Prior to that, he was with Salomon Brothers, and prior to Wall Street, he was at Bell Labs and AT&T. On the academic side, he created the first graduate financial engineering program in the country at Polytech University, which is now part of NYU. Previously, he has taught at Wharton, Columbia, and Fordham, and holds a PhD from the University of Toronto in mathematics. He was inducted into the Fixed Income Analyst Society's Hall of Fame in 1997. The discussant on this paper will be Wynn Smith. Wynn is an AI engineer at Wells Fargo. He was previously an independent consultant, a CFO, an investment banker, a municipal advisor, and a quant, a man who's worn many hats. As a quant, he developed innovative tools to optimize advanced refundings, and Wynn has shared his research on government debt markets in the financial press. So with that, I would invite Andy to begin the presentation on his paper.
Okay, thanks very much, Pepe. Rich Reifel, in his opening comments, mentioned that we have many newcomers and also many old timers. And I am one of the old timers. I actually attended the first meeting in Boston. I have always enjoyed these meetings, and it's nice to see the old timers. It's a pity that we cannot meet in person, but perhaps next year. Now, the presentation, hang on. You cannot see this, can you? I need some help here to share the screen. Hang on.
Sure. Howen, can you?
Here we go.
Do you have any slides?
All right, I'll try it again.
No, we got it. We got it, Andy. Hold on.
Okay, can you see the screen now?
Yes.
Okay.
Howen has shared them, so you'll have to tell her when to move to the next slide.
Right. How is this? Can you see this?
Yes.
All right. So
No, wait. We're seeing Howen's slides, Howen's screen, your slides, not your screen. So we can use this, but you have to tell her when to advance.
So what should I be doing, David?
Just tell, we see your slides, but they're on our screen at Brookings. So you have to tell how and when you want her to go to the next slide. Okay?
Okay, she's going to run it. All right.
Yes.
Okay. So this presentation is about taxable advance refundings. And this particular transaction was introduced around 2019. It was very popular in 20 and 21. I wasn't too sure what was happening this year, but Peter Block in his presentation indicated that there's more taxable advance refunding. On one of his slides, Peter showed 67 billion expected this year. So, Peter, thank you for that information. The paper I'm going to present, I wrote it back in 2000 and at the beginning of 2020. It was published in the Journal of Fixed Income, I'm sorry, in the Municipal Finance Journal last year. And I estimate that as of the end of last year, about $200 billion of tax-exempt bonds were advance refunded with taxable bonds. So can you go to the next slide? Okay, thanks. Here's the outline of my presentation. I will quickly tell everybody what advance refunding is about in case you're not familiar with it. Then instead of that hypothetical case in my paper, I will show you an actual refunding that I found on the web. And I'll talk about the timing decision. When should you refund? The question is, are these refundings prudent or are they premature? So the question is the timing, and I'll say something about that, and then I make some suggestions towards the end about how to reduce the cost of borrowing by perhaps structuring bonds somewhat differently than the way they are structured today. So let's go to the next slide. And again, for those of you who don't know what advance refunding is, there is an outstanding bond. It's a tax-exempt bond. It's not yet callable. It has a high coupon, basically a 5% coupon. That's the standard today. And the municipality issues a refunding bond while this old bond is still outstanding. Now, until 2017, they could issue tax-exempt bonds, but they can no longer do this. So what has been happening is they've been issuing taxable bonds, and they have also been exploring other alternatives to advance refund these not yet callable high coupon bonds. The proceeds of this new issue are invested in a so-called treasury escrow, and here's a technical term. They defease the outstanding bond to the call date. They match the cash flows of the outstanding bond to the call date. Then when the call date comes, the old bond is retired and the new bond remains outstanding. And an important part of this exercise is savings. Municipalities always report how much they saved by advance refunding. And in the next slide, if you could go to it, I will show you this. Now, this slide is indicated at the bottom. I found this on this example on the web, the Massachusetts School Building Authority, and it's very similar to the example that I have in my paper. So if you look at the paper and you compare it with the transaction here, you see a lot of similarity. So let's look at this transaction. The authority in 2019 issued $750 million of taxable bonds to refund outstanding tax-exempt bonds. The TIC, which is like the yield to maturity of the new issue, was about 3.24%. And if you assume the outstanding bonds had 5% coupons, that looks pretty good. It's 175 basis points below the coupon of the old bonds. Then these proceeds were used to refund these bonds, which were issued in 2011. Now, they are not yet callable. They would be callable in 2021. So there's 2 years between the taxable issuance and the call date. Now, here's the amazing fact here. This is out of this document at the bottom of the page. They saved $135 million. Amazing accuracy to the nearest dollar here, which is 18% of the refunded principal. 18%. We talk about 3% and 5% saving. This is 18%. Phenomenal. They saved $192.5 million in undiscounted flows. This is all on the document. They also mention that on this escrow account in this 2-year period, they earned $444,000, and that's not very impressive. And it makes you suspect if you earn $444,000 on a $715 million investment, it makes you wonder: is this a good deal? The book running manager was B of A, and the advisor on this enormous deal was BFM. Now, what you don't see in this press release is the cost of issuance. Of course, there's always some issuance cost. Let's see, it's $4 million. But much more importantly, what's missing from here is the value of the forfeited option. I'll talk about this later, but once you advance refund, you cannot refund again. And I estimated that the value of this option was 180 million. They saved 135 million. So what happened to the rest? They wasted $45 million. That you don't see. And that's the topic I would really like to focus on today. Let's go to the next slide, if we could, and talk about high coupon, just about these 5% bonds callable in year 10. What happens to them? So let's begin with something that we never hear about. When you issue these bonds, you pay for the call option. The question is, what if this 5% bond happened to be a non-call live bond? So I just assume here that you could sell it for 145 instead of 120. So there is a cost of the option, which is 25 points upfront. And when we talk about how much we save, 18% or 20% or 25%, we should be thinking about it relative to what we paid for the option. And we should expect to save more than 25 points just to make it a good deal. And the municipal issuers and advisors still talk about 3% savings and 5% savings, which is just completely inappropriate when you're in a different area when you issue 5% bonds. So when you advance refund, cash flows are locked in, 18% in the case of the authority. But as I mentioned before, you give up the option to refund later. And again, I estimate the option value is 24%. So the net loss is 6% per 100 million principal. Quite substantial. I mentioned $45 million loss estimated in the case of the transaction before. Here's an interesting question that you may want to think about. So if there's this loss of option value, who benefited from the waste? I have posed this before, and I know it's not as easy as you might think. So think about it. Who benefits from early premature refundings? Now, I mentioned one notion that I'll come back to later on, which is refunding efficiency that I have been advocating for many years. what the issuers should be looking at is how much they save, normalized by, divided by what they give up in optionality. In the typical taxable advance refunding, the ratio is about 75%. In the paper, I mentioned 70%. So this is way too low, and we should be aiming for 95 or 100%. Okay, let's go on to the next slide, if we could. And the next two slides are from the paper. And the first, this one, is actually just a break-even analysis. So let's look at it so we understand what's going on. In this case, we refunded a 5% bond with taxable bonds whose rate was 3.05%, somewhat lower than the mass school example, and saved $24 million. However, this is 2 years prior to the call date. And at this time, the tax-exempt rates were 2.5%, as indicated towards the bottom. So the tax-exempt rates were 55 basis points lower than the taxable rate. That's kind of a conservative estimate. And the question is, what if you waited until the bonds became callable and then you use tax-exempt bonds? Where would tax-exempt rates have to be 2 years from now in order to save $24 million NPV? Well, the break-even, as you can see on the right side, would be at quite a bit higher. Rates could move up from 250 to about 330. That's an 80 basis point spread just to break even. In other words, unless rates move up at least 80 basis points, it would have been preferable not to advance refund. Standard break-even analysis, and keep in mind, rates could also go lower. Who knows where rates are going to go? But the point is, at the time you make a decision, the implication is that you expect rates to go substantially higher. And by the way, that seems to be pretty standard assumption when you talk to municipal treasurers. Rates are always expected to go higher. Okay, the next exhibit is more technical. It shows the refunding efficiency. Now, what's refunding efficiency? It's the ratio of the savings by the option value, how much you get versus what you give up. And ideally, you would like to get the whole value, 100%. Well, in this case, in order to get close to 100%, you would have had to refund at 2.6%. But we refunded at 3.05%, and we got only about 70% of the option value, which is, as I keep on saying, is just unacceptably low, at least in my opinion. So remember this refunding efficiency, look at savings divided by option value. We can talk later about how you calculate option value, but at the very least, let's recognize that there is an option which needs to be taken into consideration when you pull the trigger.
Andy, you've got a couple more minutes, just so we're sure that Wynn's got time to jump
That's
in.
fine. Let's go to the next one. I have two more exhibits, and I think they are important. So how to improve the refunding decision? One, as I keep on saying, consider forfeited option value and this refunding efficiency. Don't use 3% and 5% threshold. There's absolutely no justification for it. They are not suitable for 5% bonds. They were okay for bonds when they were issued at par. You should utilize industrial strength analytics. Steve Winterstein referred to the difference between yield curves and interest rates. People often miss that very not so subtle point, and so on. Now, one important point, and I do want to mention this, where do you get help if you're a municipal issuer? If you look at the GFOE's best practices, it mentions, I did it yesterday, it mentions savings 39 times, it mentions option value once. And it says, oh, if you need help, go to the MSRB. But the MSRB certification, municipal advisors, they don't teach. You don't have to know anything about option value. So how are you supposed to be making the right decision if you don't have proper help? I'll let you think about this. Now, my next exhibit, if you could go to it, it's a general point about what municipalities should do and what should not do. This 5% non-call temp bonds, increase the call prices. Don't allow calls at par, because everything is refunded. And I mentioned a task here. Can you find any 5% bonds older than 10 years? And if not, why do we call these bonds 30-year bonds when they are always refunded after 10 years? You have huge savings, you have huge transaction costs, but these are intermediate bonds, not long-term bonds. At the bottom, I mentioned a couple of possibilities that you probably haven't heard of. One is ratchet bonds, which automatically refinance themselves, no transaction cost. And you wonder, why haven't you heard about it? TVA wonders this. They issued over 1 billion of these. The long-term bonds automatically refinance themselves at no cost. The coupon always declines, it never decreases. And issue optionless bonds. It turns out that optionless bonds have a lower expected cost than callable bonds, and it has to do with the fact that municipalities should be discounting their cash flows at their taxable rates and not at their tax exempt rates. I just wrote a paper about this. I don't want to elaborate. Let's go to the very last exhibit, because I have some, if you can show the references. There's a lot of literature, and using just the literature and common sense, I think people could make much better decisions. The only thing I'd like to highlight is this optimum bond calling and refunding that I wrote back in my Bell Labs days, co-authored it. It was in 1979. It was used very widely within the Bell system. Billions and billions were refunded using the call efficiency concepts. And unfortunately, very few people are familiar with this in the tax exempt world. One more thing I want to say, the very last reference, which has to do with what do you do about these 5% callable bonds. And as Zubin Smith suggested in his bond buyer article in 2016, increase the call prices so that you refund them only if rates actually decline. Don't refund them. You should when rates are 3%, it's go up to 4%. They are refunded and everybody's cheering about the savings. No, if you increase the call prices, this will not happen. So I'll stop here and let Win take over.
I was going to say, I'm going to give Win a chance to jump in.
Okay, thanks very much, Pepe.
Okay, great. Can you hear me?
Yes.
Okay, good. All right, hi. Thanks for this opportunity to comment on Andy's presentation. Andy's worked on these issues longer and harder than anyone, and he makes really important points. Before I begin, I'd like to stress that the views I express are my own, not necessarily those of Wells Fargo. At Wells Fargo, I apply artificial intelligence techniques to helping manage risk. But before this, I spent many years solving financial problems or helping solve financial problems for governments and businesses. I still have a keen interest in municipal finance. I took it personally when Congress abolished tax-exempt advance refundings. My inbox blew up yesterday when some market participants saw I was going to discuss Andy's paper. I heard some reasonable points, and I'm going to reflect on some of those in my comments today. I want to comment on really two big questions that are raised for me by Andy's presentation. But first, I want you to picture two characters, a treasure hunter and a farmer. A treasure hunter and his well-paid team want to dig up buried treasure as quickly as possible before somebody else gets it. The treasure hunter thrives on speed and execution. It is tactical. The farmer knows the value of her crops and expects to wait until the crops reach their peak in value. She understands risk and waiting, but she has a plan that can be adjusted as conditions change. The farmer is patient and strategic. With those two characters in mind, let's move on to the big questions. First big question is, should issuers use callable premium bonds when they finance new projects? We'll think about the cons and pros. We'll take them in that order. The cons would ally with Andy's thinking on this, I think, and a lot of what my thinking has been. One of the cons for me with callable premium bonds, these 5% par call bonds, is they don't really provide long-term committed funding for the bond issuer at a market rate, like say a par bond would. Instead, they provide really what's a worst case scenario. Worst case scenario is that for some reason they cannot actually refund them and they're stuck with a 5% coupon, and they incur really a high yield to do that. Another con of the callable premium bonds is the issuer is likely to have to refund, and so they're likely to pay transaction costs more than once, as Andy was pointing out, and they're likely to have to do an expensive taxable refunding, or at least they're quite likely to do that. Another issue with the callable premium bonds is they really create this new asset for the issuer. And let's say that it's a small school district, but now on their balance sheet, there's this really cryptic option. What is this thing and what is it worth? Is it really appropriate for, say, a small bond issuer to even have to think about how they manage an option? Also, as Andy really alludes to, the callable premium bonds muddy the waters of words like savings and maturity. You know, what is savings when you refund a bond that really kind of had savings at the moment it was issued? What does savings mean anymore? And also, what does maturity mean? Is a 20-year bond really a 20-year bond if it's really likely to go away in 10 years? And Andy's touched on those points. Another thing about callable premium bonds is if the issuer doesn't call the bond, they're going to really end up paying a high coupon that they were never compensated for. It's kind of like unpaid overtime. And if you think about the true interest cost, that's based on the debt to maturity relative to the bond price, and that's really going to get bumped up by the callable premium bonds. And I think that can be a sign of trouble. But what are the pros? They certainly may achieve the best yield to the call date, or the best pricing yield. It does need to be understood that that's the best yield to the call date is not the best yield to maturity. They can create at least a worst case debt service schedule for the issuer, and that the issuer can likely improve on. And maybe this isn't the worst thing in the world, because if the issuer sets up a worst case debt service schedule and they plan around that and they budget around that, that creates perhaps some conservatism, and that could be a good thing. Most importantly, I think in the market and what the options are available to the issuer, sometimes callable premium bonds may be the most realistic option available, or at least for part of the bond issue. There is a lot of demand for the high coupon bonds and for callable premium bonds. There are investors who really prefer the limited risk with a shorter duration and less exposure to rising rates. They do like that potential for upside if the bond isn't called. Of course, they all have been, as far as we know. And Andy and I have both recommended par call, but that may make the bond less attractive because it becomes less generic. So that has to be considered. I'd be open to trying to at least starting to increase the call prices and see what happens. But it just may not be the long-term committed funding in the sense of par bonds isn't really available from investors. A couple of years ago, I worked on a hospital issue, and we were really limited on the average life of the deal that the investors would accept, and we had to structure it so that we could beat that threshold. And I've been thinking that the market price on a premium bond, in some sense, does reflect all the contingencies that could come up with that bond, including that the bond gets refunded or currently refunded, it may run to maturity, might even default. And the price really should reflect all those contingencies, even if the pricing rules kind of make it look like they don't. And although the concept of maturity is muddled by callable premium bonds, that's not something that's totally alien to the market. So, mortgages, for example, you have 30-year mortgages, but in the mortgage market, it's understood the mortgages aren't generally going to run to 30 years. People sell their homes and refinance, and maybe the expected life is more like 7 years. So that's something that can be dealt with if it's understood. But my observations on this is I would be inclined to secure fully committed funding for the life of a bond issue if I were an issuer, as much as possible. I would rather do the equivalent of par bonds or do high call prices and make it a kind of equivalent to par bonds, where I've really locked in funding for the life of the issuer at a market rate. But if a fully informed issuer with their eyes open decides that they want to set up more of a worst case scenario that they think they can improve on, that could be reasonable. But they should consider, as Andy says, the whole lifespan of the issue. They should make a plan for managing the bonds, just as our strategic farmer plans for the whole growing season. They should not be surprised by adversities such as shifts in interest rates or regulations, as we saw with advanced refundings, or their own circumstances. And maybe it's even possible that they will be stuck with those high coupon bonds if rates go up high enough. But they should be anticipating the costs of future refundings if that's really part of their plan. But there's a challenge for municipalities because maybe one finance manager acts like that wise farmer, but when they're gone, the next one just looks at the debt schedule, sees that it's scheduled, and they think that any change from that is really savings, when really that was a worst case and not a base case in a sense. It's like getting excited that your kid is cutting C's when they used to have F's. It's not really what you're looking for. The next big question, and I see that I'm getting a little short on time, is should issuers use taxable advance refundings? And Andy has covered the cons. We know that there's going to be negative arbitrage, that the escrow is not going to be able to earn what those bonds cost. They're not going to be able to extract the value of that option. And at least theoretically, they're likely to be better off waiting. And also the savings are really misleading when they're compared again against that worst case scenario. And they tend to get overhyped. So there's a real problem with the savings calculation and presentation. However, if the rates on the original bonds or if interest rates are very low and there are rumors of inflation like there were last year, it may be really prudent to go ahead and refinance, as ugly as it is, and take away that risk of higher rates. I don't think any issuers who refinanced last year regret that. Another point is that it can be hard to know, well, what is that option exactly worth? There's the question of what is the volatility? What's appropriate? Do you look at history? Do you try to get a market volatility from another market? You're going to get different answers. And I will defend the savings number a little bit in that, at least it's in reference to the actual debt service schedule. And that is a number those are numbers that take on meaning. So I think that issuers should take the value of that option extremely seriously. And they should understand it as well as they can. And their advisors should help them understand that. And Andy's right that advisors need to work harder to understand and explain option value. Issuers need to understand how costly taxable advance refundings can be. They should not jump like that treasure hunter when they hear about some possible large savings. Just because the PowerPoints show up doesn't mean you necessarily should jump. I think issuers should act like the strategic farmer and think strategically. They should know that the savings were planted at the beginning of the bond issue. They should be harvested when they peak in value. In theory, it may be best to avoid taxable refundings completely. But in practice, issuers should not ignore their own circumstances, their own risk tolerance, where interest rates are, and the other uncertainties that they may be exposed to. So to conclude, I would rather avoid callable premium bonds as much as possible. I'd rather not have to sell taxable advanced refundings. I'd much prefer to be able to wait and sell tax exempt debt if I could. But in life, I would also rather not see appliances break down when in the old days, they used to last forever. We have to deal with reality. But we can also seek to improve on reality. And I applaud Andy for his commitment to making those improvements. Thank you.
Thank you, Wynn. We appreciate your insight. Andy, I'm going to give you 2 minutes.
That's
And I'm going to set
plenty.
an alarm because
Okay.
there's people coming behind us.
No, Pepe, there's plenty. A few comments about the premium bonds. So everybody needs to understand that institutional investors want to buy premium bonds. They don't want to buy par bonds. Let's start with that. The problem is not with the premium. The problem is the par call. So one way to do it is to increase the call prices, as been advocated, and I support. The other one is just to issue longer term optionless bonds. What's wrong with optionless bonds? We don't see any bonds over 10 years non-callable. That's one point. Second, being referred to TIC, and the problem is again with TIC is that it doesn't look at options. An alternative to TIC is option adjusted TIC. I published something about this in the bond buyer. People are not using it. Options must be taken into account. And finally, about the restoration of advanced refunding, just one comment. There was a lot of lobbying to do it. And who's lobbying for it? Primarily, if you look at it, it's the infrastructure, the people who benefit from the advanced refunding, not the issuers. It's the American Bar Association is a huge advocate of advanced refunding. And I'll stop right there.
Great. Thank you. I know this is an issue that is critically important and both of you all are passionate about, and we appreciate your bringing that passion to the discussion and to the conference.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.